Good afternoon, everybody. This is the Joe Lucy Market Huddle. I will be filling in today. My name is Ryan Dillon. I'm a financial advisor here. Again, it's National Life Insurance Day. We're going to be talking about life insurance and long-term care in your lifetime. Now, I do want you to, guys, long-term care policies, I want you to get that out of your head at the moment. That is not what we're going to be discussing today. If you have long-term care policies, a lot of times they're very, very good. A lot of them were priced a little aggressively, I'd say, and they become very, very expensive later on in life. So many of our clients, if you do have life and long-term care policies, bring them in. We analyze these things every day. Some are really, really good. Others, might need to be adjusted. They're starting to cause a little bit of pain of paying for them. But when I'm talking long-term care, I'm talking about possible nursing home, assisted living, somebody coming over to the household type thing. I'm not talking about long-term care policies, okay? Again, we got to go through the disclaimers. This information can change without notice. Any type of investing involves risk, including loss of principal, no guarantees. Our firm does not assume liability for loss, which will result from any person. This is based on information and opinions and us talking about these strategies throughout this presentation. It's very general. Today is going to be a little bit more facts-based. We gathered a lot of information about this and just really tell you what the trends are coming forward here with the cost of healthcare. It's to put it simply, it's astounding on how much this rises. So we'll get started here. I want to talk about protecting your retirement. We're going to talk about what to consider if insurance is part of your plan and how to begin that conversation, and some strategies to implement it. And what it regards and what it entails. But I first want to set the table here a little bit. As many of you possibly were aware, we had David Walker in, former comptroller of the United States government. We had him in last week. It was a phenomenal presentation that he gave. I'm going to bring in some of the facts and things that he gave us last year if you were unable to make it. But really shined a huge light on long-term care and Medicare, things of that nature, coming from a guy that was inside, right? He was on Pennsylvania Avenue there. He had his hands in the sausage. So really enlightening stuff from David Walker. And again, I urge you guys, whenever we have guys like this coming to town or gals, it's very, very educational and something well worth your while. So what he brought up, or what some of the things he talked about during his presentation, were the facts don't lie. We're living longer lifespans. There are greater long-term care needs, and I'll set the table on why. There's going to be more onus on you to help afford these things than relying on the government. Because as you'll see here with some facts, it's just the numbers don't work out, and there's going to be some major changes coming down the future. As you know, higher taxes are possibly going to be unavoidable. With throwing $6, $7, $8 trillion at the economy the last 2 years, we've really kicked that can down the road here, and there's just no other way to pay for it but raising the taxes. What David Walker talked about is revising the social insurance contract. And he brought up Social Security, and I'll show you some numbers here to back it up. Social Security, Medicare, Medicaid, just extremely, extremely underfunded. And there's no other way to look at it, but there's going to be some change happening. Hopefully not in your lifetimes, but definitely in the future here. We just got to be ready for it. We have increased uncertainty in the world. That's, with Ukraine and the stock market going on, we definitely see that, the administration and what we're doing. And what you've seen here on your own accounts, increased volatility. The market is down 10, 12% here the beginning of the year. It's one of the worst starts to a year in the stock market that we've had. So building some protection strategies, building some life insurance for possible rainy day situations that is tax-free to not only you and your family, something to consider and talk about. The birth burden is what David Walker talked about. We all see the debt, right? I believe it's $39 trillion worth of debt right now, right? And that's debt owed from other companies and countries and things of that nature. What we don't hear is what he said are these numbers that he shared with us last week. Total liabilities, including debt held by public pensions, retiree healthcare liabilities, almost $30 trillion. Go to the second bullet point there. Social Security's unfunded obligations right now are $22 trillion. Medicare unfunded obligations is $48 trillion. Miscellaneous, he gave a number there. Social Security, Medicare, intragovernmental bonds, $6.2 trillion, and commitments and contingencies, less than $1 trillion. But again, that Medicare and Social Security right there. Medicare, importantly, is what we're going to talk about. Unfunded at $48 trillion. We have made promises we are well behind keeping right now. Unless there's major overhaul, major changes, major possible reductions in your Medicare planning, we're going to have to pay the piper at some point in this. So again, I'm setting the table here that, again, we have promised too much, or the American government has promised too much to the people. We've got to come up with solutions to get a little bit more, covered with the assets that we have and that we've built throughout retirement, and not try to, solely wait for this to help us out in that day where we're going to need it the most. So what's the financial impact of all this in retirement? What are we looking at? So, I've set the table here. We know we've had some changes. What does that look like moving forward here? And what are the trends we're seeing today with healthcare and that type of coverage? If you look at the graph here, healthcare, costs of rising inflation, and also workers' earnings. An astounding number here. Since 1999, family premiums, healthcare has gone up 284% in roughly over just a couple of decades. Now, workers' earnings have kept up with inflation down below, and this goes to 2021. Okay, people that are working right now, they haven't really felt the pinch because workers' earnings have beaten inflation over time and helped cover that family premium when it comes to healthcare costs. But in your retired years, and when we're on a little bit more fixed income streams and we've built assets we're pulling from in a safe, reliable manner, that increase in healthcare costs you're going to start feeling the bite. And in fact, this chart here will be radically changed when we add 2022. This was the first year in about, I don't know how many years, certainly over 20 years here, that overall inflation went above the workers' earnings line graph there. So is the trends on family premiums going up. Overall inflation has spiked up. Workers' earnings are not keeping up with it. And, with fixed income, those of you on Social Security right now, you probably saw and you're very happy about getting that, a 5.9% increase in your Social Security. Nice, right? Yeah, we're battling inflation. Inflation's a little bit higher, but boy, almost 6%, boy, okay, we're trying to keep with it. Well, what the story doesn't tell you, and what you guys have probably already noticed, and what you will start to notice, is that Medicare premiums went up the same, about 12 to 14%. So, the rise in the paycheck you get from Social Security is great, but actually they doubled the amount of Medicare, which we're going to start feeling as we keep going along. A lot of times when we're having meetings, myself, Dylan Malberg, Joe Lucy here in the office, everybody says, well, I'm going to spend less in retirement. This is from the Bureau of Labor Statistics from the government here. We're going to be spending less. I'm not going to be doing much, things of that nature. Folks, that's simply really not a true statement. The money you're spending now tends to stay the same, if not, we'll show you increase here. Food and beverage, you'll see spending all ages, and then spending on the right column is 65 years and older. Food and beverage, roughly stays the same throughout your retirement. Obviously, now let's unbake the inflation that we are currently putting on our numbers in real life, but this was a little bit before. Food and beverage really doesn't change very much. 11.72 through your lifetime, 11.24 as you're 65 and retired. Housing, same thing. Housing goes up a little bit for you in retirement. Hopefully some of you pay off your mortgages. That's great. Things of that nature, but not everybody can do that. Apparel, we spend clothing 2.3% as we grow up and moving through our accumulation years. Spending 65 and older on apparel goes down a little bit. Understandable. I am 40, almost 47 years old. I do not spend money on clothes anymore. I really don't care what other people think I look like these days. I try to look nice, but spending on apparel goes down. Sorry, bad joke. Transportation goes down a little bit. We are not buying as many cars in our retirement years as it seems. It does go down. Not flying around as much in the later years, things of that nature, traveling as much. But healthcare here, the next statement here is, when we're spending on healthcare as we're in our accumulation years, 8.29%. Jumps up to 13.15% over 65 and a half. That's a very good increase here. Everything's staying the same, maybe a little bit of drop, but boom, healthcare comes in. And as you can see, entertainment stays right there too. So the idea that we hear in multiple meetings is I'm going to spend less and I'm going to spend, a high amount in my first years of retirement, and then we're going to really buckle down and things of that nature. It's just simply when you line it up and do the facts, and it's just simply not true. You really stay pretty steady. Actually, you increase in retirement. And that's what we're talking about in retirement, right? We're talking about giving you an income stream where you can spend securely in retirement. We're talking about reducing your taxes again, right? And then our third phase of planning, we're talking about that healthcare, that legacy. How do we build and how do we plan for that? So we want to, encourage you guys, and we try to make sure we're talking about this with every one of you. But if we're not, you feel like we need a revision, and especially after some of the numbers I say today, get on in here. Let's talk about it. It's never too late. It's never too soon to start talking about this with some of these numbers here. But it's estimated that somebody turning 65 today is almost a 70% chance of needing some type of long-term care services in their remaining years. 70% chance. Okay. What does that mean? Long-term care. We're talking about assisted living. We're talking about nursing home costs, possibly, right? Medicare, Medicaid handles such certain things, but Medicare doesn't handle nursing home coverage, assisted living coverage. It might handle a little bit, but it really does not. The bulk of it's got to come from you or your family. A lot of what we hear is we don't want to be a burden on our family, and we're going to talk about that a little bit longer here too. But today, the average annual nursing home cost is about $108,000 per year. With those graphs I just showed you, with going up, 12, 14, 16% a year, what does that look like in 2041 here? If you're 60, 65 years old today, we're looking at almost $200,000 per year to give you the type of coverage you need when you need it the most. Nursing home, assisted living, things of that nature, $200,000 a year that are right now not going to be covered by a government fund, Medicare, Medicaid. As we talked about, there's probably going to be some adjustments to Medicare and Medicaid, and maybe they reduce your values of what you're receiving. All right, we've kind of proven with those numbers that David Walker gave us that we just can't continue to go down this path. So you got to start having this picture here of what do we need to have in our back pocket if I've got to do this myself, and if government's not going to help me. In fact, let's not rely on government to help us, because you know how many things they get right. So let's start building things now that can build an increase and help us out when that time we really need it. A little bit more numbers to back up what we're talking about today. These are today's dollars of what we're going to need projected healthcare costs throughout retirement. $352,000 $1,000 of what we need today in a bucket to handle our healthcare costs as we go through retirement. Okay, this is assuming a life expectancy for a 88-year-old male and a 90-year-old female. Got about a 5% increase on this. Now, what are these expenses going to be 20 years from now? 65 to 85? Like that other graph showed you, this number is a little bit different. This is from another Millman healthcare cost estimates of 2021. But that other one said 249% higher. This one's going to be 232% higher. But the bottom line is we're up in the 200% higher as this thing creeps along in the long-term vision of your retirement. We've got to do something about it today. We've got to start talking about it today. Okay. The family factor, right? Don't want to be a burden on your kids. Now, I lived this a little bit here. My grandmother, Lucille, she was widowed at young 30s. My grandfather passed away a little bit after the war. She had 5 kids on a small farm in Milwaukee, Wisconsin. Grandma Lucy kicked butt. She raised those 5 kids. She was a nurse her entire life. But as she got older here, we had to start giving her assisted living. Now, every penny she made went into the house, the kids there. She did not have a savings. She also got into nursing before those nice nursing pensions and things like that came along. So we didn't, Grandma had her Social Security. She had a small military pension from Grandpa, and she made it work here, raising 5 kids, one of them being my mother. When Grandma Lucy got to be about, I want to say it was about 85 years old, 84 years old, we had to move her to transition, some assisted living, right? Her own apartment, but in an assisted living facility. Some workers around there to help her out, check on her a couple times a day, things of that nature. At 84, right? She progressed obviously into more of a real nursing home establishment. And then, towards the end of the day of her life, more into like memory care and things of that nature, and then eventually hospice. All in, Grandma Lucy was in the nursing home assisted living environment for over 10 years. Okay, 84, she passed away at about 95 years old. All right. Now, what the family factor is, with Medicaid and that she was on, it helped cover some of the care here, but it doesn't tell you what kind of care. And, Grandma Lucy was in a room with another person. We were sharing bathrooms, things of that nature. And we wanted to give her some extra care. All right. So what the family had to do is 3 out of the 5 siblings each chipped in a monthly amount to put her in her own room, to give her a little bit better care, better coverage, things of that nature. But it boiled down to be about an extra, from my parents, it was about $1,000 a month. My uncle, my aunts, they all put in about an extra $1,000 to $1,500 a month so we could elevate my grandmother's care. All right, so that it is a pain point. It gets there, and I remember my mom sitting up at nights thinking about the care, the coverage. How do we get it better? How do we get it more? I remember sitting up at nights really worrying about this. So the family factor here, from numbers from Genworth study done in 2021, 66% of the caregivers, family members, paid for care from their own savings and their own retirement funds, your kids. 55% of these caregivers lost income as a result of helping, their parents get through these retirement years, when we need medical help. That's because the more time we got to give, obviously, the less work we can do. And then 42% of the caregivers experience feelings like depression and resentment. I saw that with my mom. It's a real thing. It brings down the quality of life. And one of the reasons I actually became a financial advisor and got into this is seeing how it affected my family, how they had to delay their retirement a little bit because of the monthly outcome of income they had to pay for my grandmother, things of that nature. So it's definitely a real thing. So what is our strategy here? What do we need to talk about? Well, there's a few different ways. There's self-insuring. If we've done a lot of great building of our assets and things, let's put them, right now, it said we need a bucket of about $350,000 to cover our healthcare expenses in life. So how do we take that? If we do have that as assets, how do we take that, invest it responsibly, invest it safely, so we know for pretty gosh darn sure when I need that money from now that it has some growth into it, and then I can go get it, and I know it's possibly not in the whims of Wall Street, and we're not just teeing it high and let it fly. There's life insurance that has a lot of long-term care possibilities to it. And then again, there's Medicare, Medicaid, things of that nature that will help. But as we've seen and as we've shown, we have promised more than we can deliver here with Medicare and Medicaid. So, the bottom one, hopefully it's there in some term, but I'm not going to count on it here with you guys and our clients. We're going to try to build this as best we can with the assets you guys have. So there may be another option, and life insurance is an option with this. Long-term care policies, very narrow focused, very for your Medicare, your medical needs, things of that nature. A life insurance policy, and usually an index universal life, it's a permanent policy, or a whole life policy can have some of these functions too, has a lot greater flexibility for you. There are long-term care riders in here that are baked in. They're usually very cost effective, if not, part of the policy. There's no additional extra riders. Usually they come with the policy, but they provide the insured or the owner access to policy values that can be used to help pay long-term care related expenses. And what we call that here is it's called living benefits. Okay, when you get into this is life insurance. When you get into a life insurance, you get a death benefit, right? Well, now that death benefit used to be, when I said, forget about what your parents' old life insurance policies are. This is a death benefit we want you guys to use in your retirement. It's called a living benefit, okay? In order to pay for this long-term care, you can borrow against that death benefit, saving your other assets, in order to help you at a time you might need it most. And by the way, this is tax-free, okay? Nothing pains us more here at Secure Retirement is when you have an emergency in your life and you've got to withdraw funds, that you get a bill from Uncle Sam the following April saying, hey, sorry about that emergency, but oh, by the way, we raised taxes and you owe us 22% of what you guys had to raise out, or 24, or whatever the tax bracket is. That's not, those are problems we like to solve, okay? But they got this long-term care benefits in there, right? And if something does major happen, if it's real quick, there's a tax-free death benefit to beneficiaries. But really, really flexible policy here. And how it works is on the left side, premium is paid into a life insurance policy with a LTC rider. The insured qualifies for long-term care rider benefits. There's chronic illness, there's terminal illness, there is critical illness. Sometimes critical illness is 2 out of 6 ADLs. You can't do 1 or 2 of those things. You want somebody to help come over and get, cut the lawn for you. It's just too much. You can pull out of these policies tax-free, pay your son or daughter to come over to help the lawn, help you with those expenses. But the beneficiaries receive a death benefit, income tax-free. The policy owner receives a tax-free acceleration of death benefit. It's called those living benefits that we talked about with long-term care possibilities. And then if anything's left over, the beneficiaries still get a long-term death benefit. Obviously, when you do use this in a way, and we want you to use these during your lifetime, the values, your accumulation value, your death benefit value will drop. But as you know, with any life insurance policy, when you tell them the premium you're going to pay, they're going to give you a death benefit above that. Anything left over goes tax-free. So again, the flexibility of these things that you can use them for, not only for long-term care, not only for taking some money out tax-free to better your life in retirement. None of it is needed to exactly spend on long-term care. You can go use that to, pay off your lake place or your cabin tax-free. It's very, very flexible. And by the way, usually this kills two birds with one stone at secured retirement, right? We talk about income planning. We talk about reducing your taxes in retirement. And we talk about long-term care, healthcare planning. Reducing your taxes, you use your IRA funds, you fund a permanent life insurance policy for, 1, 2, 3, 4, 5 years. It's basically doing the same thing as what we are doing with other clients with like Roth conversions, right? We're getting from a tax later money to a tax never bucket that's safe and protected. It's indexed. It has multiple strategies like long-term care, death benefits, the ability to take out tax-free money, and more a protected bucket of money, which is a permanent life insurance policy. So when we're talking next time, we got to know your risk. What are your beliefs about this? Well, how do you feel about long-term care? Do you think you'll need it? If so, how much do you think you'll need? And how long do you think you will need it? Everybody's different. We got to answer these questions on a continued basis. I hope we provided some clarity here on the flexibility, the tax-free nature that you want to start coming and talking to these advisors or let's reevaluate it every time we're talking together. But, that does it for me when we're talking about this on a very high level. Our upcoming events, May 9th, rising cost of inflation, the impact on your retirement. That'll be handled by Nate Zeller. And then the following Monday, the Great Reshuffle. Remember your 401k. They just came out today, the Secure Act 2.0, we're calling it. A lot of big changes possibly coming down the pipeline. They're moving up the RMD date. They're going to phase it in, it sounds like now. 72 is now going to become 73. The following year, it might be 74. Looks like the following, in about 10 years down the line, it'll be 75. So a lot of big changes here. Definitely don't miss that Monday, May 16th one as we dial in and learn about more of the changes coming to this. But as always, if anything piqued your interest here, we want to talk a little bit more about this. Call us up, schedule your retirement plan today. We are very busy, but we've got time on the schedule. If this is important to you, we definitely want to get you in. And, I just want to thank you guys for being clients. You guys are wonderful. Anybody out there that's not a client, please do call our office. We'd love to talk with you and help you out to make sure you're spending securely in retirement. Most importantly, reduce your taxes in retirement. And like we talked about today, being able to fund some of that health care that we need in retirement. With that said, I wish you guys a happy May. I hope the sun comes out, and we'll talk to you all very, very soon. Have a great day.